Welcome to the Movie Market Podcast, October recap. David, lots going on, in the world, earnings, a lot of volatility in the markets. Let's start by kind of recapping October and then look ahead.
Yeah, Jared. So if you look at October, it was a very strong month with overall performance, but the performance was mixed. And so if you look at, the S&P 500, it was up around 2%, but that was mostly driven by large tech and AI, a lot of the Magnificent Seven names. You saw the large value underperforming significantly. So large value and some of the equal weighted index underperformed the S&P by about 4%. And another bright spot in the portfolio continues to be international this year. International recorded another strong month, and it's really what's helping keep portfolios in line if you're balancing risk and don't have as much allocation to the big tech names. And for the first couple days of November, we're seeing that that's paying off as well. And then if you look at equity income and some of these other value names where they're starting to emerge more opportunity, you saw that the index was actually down 2 to 3%, depending on which one you look at. Our equity income strategy continues to be up and is having a record year of outperformance. Not obviously as good as S&P in growth, but still double-digit returns compared to a flat to negative index. So you're seeing opportunity in the market, and it really is a mix between the companies that are doing well and the companies that continue to struggle.
Well, David, when you look at kind of the market and the concentration risk, we've really talked about in the last couple of years, really at this point. And, my feeling has been since May that you have this continued positive momentum in the markets. But as you look toward the second half of October, right, you had big earnings outperformance by some of these significant companies. And in some of the days, the market looked like it was up, but it was really driven by one company or two companies. And right, and to me, that's very reminiscent of the late 90s, where you had a few companies driving the overall stock market indices, and again, tends not to be a long-term sustainable strategy, or performance record of the markets overall. On the other hand, Nvidia, for example, hit $5 trillion, for the first time ever. So you're starting to see some of the concern around the concentration risk within the markets. But again, it's difficult to have a handful of companies continue to drive everything, right? And you have, and to your point, international continues to be, up almost 30% through the end of the month, right, has really helped drive the diversification overall. So now as we look to the economy, David, I mean, it's obviously difficult from the market perspective that with the government shutdown, we've had almost no economic data in the month of October. So really what we've had to do is lean toward company earnings results to see what they're saying. On the other hand, still from the Fed perspective, they did cut interest rates at the end of the month, right? Second time, this year. Now we look ahead to December. What are the key things, I guess, from the Fed perspective now? I mean, the labor market seems to be the number one reason why the Fed cut rates, but obviously there are other factors ahead too.
Yeah, Jared, as we talked about labor, it really is, the biggest driver of the U.S. economy. We've mentioned this number many, many times, and the U.S. economy is 2/3 consumer driven. So labor becomes very, very important. And as we look at the labor picture, it hasn't been as robust as we've seen in recent years. So if you, for example, look at where overall labor and employment is, we don't have government data, but we do have ADP, which is one bright spot of at least a way to assess the market. But you are seeing that, job growth has certainly slowed. If you look at job growth over the last several years, and compare it to, so far this year, you can see that you were creating jobs at about 126,000 jobs a month pace. So about 3 million jobs were created between January of 2023 and January of 2025. If you look at January of 25 to October of 25, so this year, job growth a lot more muted, growing at a pace of about 34,000 jobs, which is a pretty meager number. And at some point, as we saw in the previous months, there could be months of negative job growth. The other thing to look at with job growth is where those jobs are coming from. And really what you're seeing is larger companies are continuing to add employees, whereas smaller companies, continue to shrink, and there's fewer of them. And that's where you're seeing some of the translation into the negative consumer sentiment, you've seen that drop to the almost to the lowest number ever recorded. And the Fed is going to very likely need to continue to cut rates to stabilize the economy. The question is, will rate cuts be enough? Because as you look at where some of the job losses are stemming from, a lot of AI is replacing what very high paying tech jobs, a lot of times programmers that make $300,000 to $500,000 a year. And you can lower rates to lower borrowing costs for companies, but some of those jobs may not be coming back. And so this is going to be an important trend for us to continue to watch.
Well, David, you look too, as you mentioned, I mean, the Challenger job cut survey was, the largest in a very long time, up 175% from the prior month. And we've seen anecdotally 10,000 jobs here, 20,000 jobs there, a few thousand with company announcements over the last month, right? So the question on a lot of people's mind is it going to be a lot like 2022, where there are a lot of job cut announcements by big tech and many other companies. And there was a lot of concern at the time. It didn't translate to a huge number overall, even though a lot of these made headlines. This time around, I mean, the economy is 3 years more mature in this cycle. And you look at some of the challenges with the government shutdown and other factors. I mean, this one feels like it's a bigger challenge from the Fed. So, likely more different than 2022. And again, as you said, David, the challenge with the Fed is, will cutting interest rates really help create jobs? Not likely in the short run, given what we're seeing with all the efficiencies of AI and other factors. But there's no question, as you look at economic growth now, which has been solid, the second and third quarter. As we look to the fourth quarter with 6 weeks of a government shutdown, now talking about cutting, flight paths by potentially, flights overall 10%. I mean, it's definitely going to have some negative impact on fourth quarter GDP. The question will be how much and when, right, at this point. And as you said, consumer confidence between the shutdown, the labor market being slower and other factors, right? It's a challenge for the Fed looking ahead. So as you look to the December meeting in a couple of weeks, I'd still be in the camp that they're likely to cut interest rates for a third time and see where we go into 2026.
Jared, the current GDP estimates for the fourth quarter with very limited government data that is used to build a model currently indicates that it's a 4% rate of growth. Do you believe that number, or do you think that maybe some of those data points, as they become available, will show that, we're not at record growth?
Well, it's hard to tell, David, because we talked about this last month. I mean, you look at the first half of the year without the data center and all the AI investment, the economy grew at 0.1%, according to Harvard, the first half of the year. So I think the wild card in the third quarter and fourth quarter is how much of that AI data center and that huge investment. You saw big numbers again continue to be announced from tech companies. Will that offset the weakness of other areas that we're concerned about, right? It's hard to tell, but again, our best guess would be it's going to be less than 4% because some of the factors we've seen and other issues. But like I said, the challenge everybody's talked about, including the Fed at their meeting at the end of the month, is the K-shaped economy, where you have big parts doing very, very well, high-end consumers, you name it, and then you have the struggle. I mean, look at the elections that happened on Tuesday, right? I mean, it was a big shift over from Republicans to Democrats, and a lot of the factors, the K-shaped economy, probably led to some of this. Clearly, the government shutdown impact, the consumer confidence with all this going together, and inflation in certain cities and issues altogether. So again, it continues to be a challenging hand dealt to the Fed at this point as to how do you balance all these factors. And clearly they're most concerned about the labor market at this point, even though, if we look at inflation quickly, inflation continues to, move up a little bit over the last few months, despite, the progress that was made, earlier in the year.
Yeah, Jerry, with the government shutdown, and again, we do rely heavily on government data. There are a lot of other data sources that we use, bank earnings, banks report a lot on just activity they're seeing, growth in credit, defaults, things like that. So there are a lot of data points, but the government does put out a lot of good data, and it's been somewhat limited. They did publish the inflation numbers because that has an impact on Social Security and other things. But as you mentioned, inflation really improved in the earlier part of the year. It kind of reached its lowest level, at least for the headline number in April, and it's slowly been ticking up from there. So this number at 3% is actually slightly better than expected. But the question is, where does it go from here? And I would say that, the one bit of positive news is the numbers that are going to be rolling off in the next couple months are going to be very significant. The November number was very high. The December number is very high. It's about 0.5% per month. And so you can actually see inflation start to improve a little bit, which would give the Fed a little bit more flexibility to lower rates. Jared, do you want to talk a little bit about the balance sheet tapering that's going to be coming to an end? Because I think that was an important one as well.
Well, to your point, David, the Fed announced, which was somewhat expected, probably comes a little earlier than the markets thought. So since COVID, the Fed expanded their balance sheet, printing, close to 5 trillion of dollars that went into the financial system overall, peaked around 9 trillion. Over the last 2+ years, the Fed has slowly tapered the balance sheet, meaning as bonds matured, they pulled the liquidity out of the system. So you went from over 9 trillion balance sheet to around 6.5 trillion, which is about the level the balance sheet was after the first infusion of liquidity during COVID. So now they're going to slow the tapering and halt it December 1st, which in theory means there'll be more money going back into the system. And then at some point, just because of currency and other factors, the Fed will start to have to print money again next year. And depending on where the economy goes from here, that gives the Fed an extra tool to support the markets, the financial system, and other things looking into 2026. And again, as we conclude, I think the challenge is always where do you go from here, right? And I think in general, it's been a solid market return across the board this year. There's a lot of companies that are down, right? We're running a list right now of companies down 30% or more over the last 12 months, and you got hundreds of companies that meet that criteria. So there is some decent value within the markets. But I think, as always, is just be mindful of taking some profits along the way, right? The big companies have done fantastically well. And it's just the challenge between, two months or so to go to next tax season. I think you just want to continue to stay balanced. I think international will continue to be a nice hedge for portfolios, as the biggest US companies have grown so large over the last number of years. And we'll kind of see what happens as we get to holiday travel and when the government reopens, see what the impact is. So with that, I want to thank you for tuning in, and we'll touch base next month.
Thank you.